So welcome back to 529. Today is a big day. Today we start with money. Okay, finally we go out beyond the real models. Yeah? And so what we did so far, first we looked at a simple real model, Buzzer, Coco, and so forth. And then we looked at the endogenous risk dynamics, and then we did jumps with sudden stops. There was a vulnerability region. Within the vulnerability region, you can jump from one equilibrium to another equilibrium. And now today we start with the money models. And we start with a very simple model, introduce idiosyncratic risk and try to solve it. And then later next time, what I will do, next time I will introduce idiosyncratic risk, which is time varying. And then I will also go through some different monetary models to contrast the different monetary models more in detail. And I will use this toy model, or this, what I call the I theory without an I. So that's a very simple one sector model. And we'll illustrate the main economic monetary insights. And then we go to a two sector model subsequently when we go then to lecture this bullet point number 2. Yes. So so let me just say the intuition for different monetary theories I will provide today, but we will go then, after next time, we'll go much more in detail. So today, first we'll talk about the monetary models in a one sector model with constant idiosyncratic risk. So we introduced today idiosyncratic risk. I will tell you what a safe asset is, a little bit about service flow, what an asset does, not only pay off cash flows, but also a service flow, when you can mine the bubble. And we'll talk about two different asset pricing perspectives. And I'm using this new form of a SDF, a new stochastic discount factor. And next time, I will then introduce a time varying idiosyncratic risk. And then we really have a safe asset, which has a negative cap M beta. So it's an asset which appreciates in times of crisis. So it's really good to have in times of crisis. And we will talk more about the debt Laffer curve, how to resolve certain debt valuation puzzles and so forth. That we will do next time. And then subsequently, I go more in detail to different monetary theories and also introduce the medium of exchange role of money. So again, so here are the three roles of money. Store value role, because a bond is less risky than a capital, because a capital has some idiosyncratic risk associated with that. Okay, so there's now, today, there will be no aggregate risk, only idiosyncratic risk for simplicity. And the government bond will be a special asset, okay, and it serves as a good store of value. Now, the second role besides the store value role is a medium of exchange role. That's the second role. And what it helps, it overcomes the double coincidence of wants problem. So that's illustrated in this little picture here. There's a Mr. A, Mrs. B, and Mrs. C. And A has some apples, but he wants some cherries from Mr. C. And B has some bananas, and the C wants this banana. So there's nobody who can do a barter. A and B cannot do a barter because A would like to have cherries, and B would like to have the apples, and nobody. So they have a double coincidence of wants problem, and the barter economy doesn't work. So typically, what works is you introduce essentially money, and this money helps you to overcome this double coincidence of wants problem. And this service which money provides, that's, this medium of exchange role of money, that's special to money. But that's, that the government bond doesn't provide this service. So a narrow form of money provides this service. And we will do this after next time. Today, we will focus only on government bonds, which are store of value. They're very good for that. But if the money takes on a special form of government liabilities, like the money gives you then a special role and gives you the service flow on top of it. While the bond gives you service flow already with just a particular one, store of value service flow, the medium of exchange service flow is on top of it. And then there's, of course, the unit of account role of money. And the unit of account role of money can be seen in two different ways. One is an intratemporal phenomenon, which is more related to the measurement of wealth. Okay, and in a world where people are boundedly rational, or they have behavioral elements to it, it matters how you measure wealth. It's a little bit like I don't know who of you comes from a country where temperature is measured in Celsius. All of you. Uh, so when you come here and suddenly everything is in Fahrenheit, it takes a while to get used to it. No. Similarly, if everything is measured in your local currency, to go to the supermarket, and then suddenly everything is in a different currency, it takes a while to get familiar to that. That's, of course, a behavioral thing. We will not incorporate this in our models. But that's the intra-temporal unit of account, how you measure things. So you can measure length in miles or kilometers, or in temperature in Fahrenheit, or in Celsius. And that's also one thing, which also in terms of wealth, whether I measure it in dollars or euros or in pesos and so forth. And the second thing is it might have an intertemporal perspective, and that has a very important thing, how debt, for example, is denominated. So if debt is denominated in euros or in dollars or in pesos, in a setting where markets are incomplete, it matters, okay? Because if there's some inflation risks, then, depending how the exchange rate moves around, or that makes incompleteness complete and incomplete in different dimensions. So we will deal with this later in a later lecture. And ultimately, it also depends on the wage and price stickiness as well. That's also an intertemporal thing. So there should be no price stickiness here. It should be only here wage and price stickiness, this element. And of course, money is also, you have a record keeping device. You have, let's say, a ledger where everything is recorded, or you have a blockchain where things are recorded. So money is typically also memory. Everything is kept written down in a ledger. It's like a database. Okay, so if I put this in now, different forms of monetary theory is just a big picture overview. Is that, the store of value bond is less risky than other capital, so like say a physical capital, or even stocks. There's no idiosyncratic risk associated with that. And the government bond is typically a safe asset. It's a special safe asset, a particular safe feature. There will be flight to safety, and that actually is very useful and overcomes essentially certain frictions which might be due to incomplete markets or the OLG, overlapping generations. We will deal with this today. And the store of value emphasis is very much the fiscal theory of the price level is touching upon that. So fiscal theory of the price level has many elements. We will touch upon this after next Wednesday. But typically, one element is a key equation, and that's the fiscal theory of the price level equation, which is the value of all government bonds in nominal terms plus the value of all the money divided by the price level. So it's the real value of all of that, is the expected present value of all primary surpluses of the government. So how much of the deficit or surpluses of the government budget, excluding the interest payments. That's why it's called primary surpluses, because it does not include the interest rate payments. This can be our stochastic discount factor back to time t. And there's also, for money, there's an additional convenience yield or some interest rate advantage, because you get an additional relaxing the cash in advance constraint that actually gives you some interest rate differential. And from little t to cap t, and then it goes on from cap t further. And if it goes to infinity, you can take the limit as cap t goes to infinity. And the fiscal theory of the price level also has this monetary versus fiscal dominance. We will talk about this next time as well. Now, that's the fiscal theory of the price level is really about the store value aspects. And the medium of exchange role is like overcoming this double coincidence of wants, which I just talked about. It's a more narrow meaning of money. It's not all government debt and all that. We can think of a special government bonds. In particular, if you think of reserves provided by the government for the banking system, they pay interest these days. Or if you think in the future about central bank digital currencies, they're essentially also, if they were to pay interest, they are very similar to T-bills. It's also like a government liability. And so monetarists focus very much on the medium of exchange role of money. It's less the medium of exchange, less the store of values, or more the medium of exchange role. And for this is the famous quantity equation, where the velocity times the money is equal to the price level, the number of transactions. And often the number of transactions is proxied with GDP or here denoted by Y. And then you, of course, the unit of account, we talked about this already. That's where the New Keynesian theory is focusing very much on this wage and price stickiness here as well. So that's typo again. Good. So I should actually make the fiscal capacity as T on this L. I should be also capital letters. Now, the next thing I would like to mention briefly is what's the difference in credit and money. So credit is essentially something somebody extends credit and somebody offers a credit. So credit is in zero net supply. So there's a creditor and there's somebody some borrower and a lender essentially. And money is in positive net supply. Okay, you can think of money to some extent in positive net supply. And so because in particular outside money is not a liability, strictly speaking, legally speaking, to the government. Okay, it's just provided here as a fund. And there's also a sense that if credit works perfectly, if there are no frictions at all, and if credit can already overcome this double coincidence of wants, then there's no role for this narrow form of money. There's government debt typically, and then we will not do that, is yields also convenience yield because it relaxes some collateral constraints. So often, US treasuries are very particularly good in serving as a collateral. And while money is very much, it offers a lower cash flow interest payment because it offers this medium of exchange role in addition. Okay, and as I said, reserves are money. So typically money is cash, reserves, and central bank digital currency would be a narrow form of money. And how should I think of reserves when they're interest rate bearing? What's special about this? It's just another form of government debt. And you can think of it is actually a debt contract with infinite maturity. So reserves never mature. They run forever. So in this sense, it's more like equity. There's no rollover risk. And they have zero duration, but you can change the interest rate on the interest rates you pay on the reserves. Okay, so the reserves since 2008 in US and in other countries even earlier, you pay interest rate on reserves. So if the bank is parking some money with the central bank, then you get some interest payment, the policy interest rate, and that moves around. Right? It's a floating. So it's like a perpetual bond, but it's floating interest payment. Okay. And the third difference is that it's typically has to be held by the banking system. So except if they're CBDCs, it's like reserves for all, then citizens can also hold some reserves or some CBDC. But typically reserves are held by the banking system. They cannot be brought outside of the banking system. Okay? And the banks, they have to hold it. So if the central bank says this amount of reserves are put in the system, the banks have to hold it. And there could be financial repression to force the banks to hold a very low interest yielding reserves. So cash is, especially, it pays no interest. Okay, so it pays no interest at all. And of course, the role of cash might be changing as new fintech companies come along. Credit and money becomes a better substitute to each other. You can swap more easily from one to the other. The velocity is changing. So fintech has a big role to play. So here's just a big picture to get the roles of money, because we now deal with these 4 different forms of money. Today, we will focus very much only on government bonds. Okay, we won't go into particulars of different forms of money. So as I said, what we will do today is the second block here. We do a one sector model with constant idiosyncratic risk. Next time we do time varying idiosyncratic risk. Okay. And we do it simpler than we had before. We have only a one sector. We don't have 2 sectors. So far, we always had an expert sector. We had a household sector. Now I would like to keep it simple and kill the household sector. Essentially, we only have the expert sector. So we don't actually, I should strike this out too here. We have, there's certain AK technology as we always had. Then there's a consumption rate C for the experts and investment rate E for the IOTA for the experts. And if they invest more, then the adjustment of the capital stock changes, the percentage change in the capital stock. That's the depreciation rate of the capital stock. And each individual expert can buy and sell from the other experts as well. And then there's and this is new now, there's this idiosyncratic risk. So whenever something is idiosyncratic, I put a little tilde on top of it, okay? So first of all, there's a superscript I tilde. So typically, remember our notation, we had I was the sector or the group of agents, and tilde is now within the sector. Now we have only one sector, so it's I tilde is within this particular sector. I probably should have called it here E for the expert sector. What I will do from now on, I drop this superscript E so that it will not show up. And so the expert sector cannot issue anything to the household sector now because there's no household sector. So they can issue risk-free debt if they want to. They can also buy risk-free debt from each other. Okay. And then everybody has the same time reference rate, and everybody has constant relative risk aversion utility function. Okay, with a gamma. And often I will go first to the log utility case and then to the constant relative risk aversion utility case. Okay, so it's simpler than before. So the only new thing is this is not an aggregate shock. This is now, how many Brownians do we have? N, or a continuum of Brownians. Now, because we have a continuum of citizens in the country, and each citizen gets his own idiosyncratic shock. Okay, and it's scaled up. So that's, if there's more capital, there's also a larger shock then associated with that. So we have a continuous time, infinite rising setting. There's one consumption good only. There's a continuum of agents. And in this model, perhaps I should, they operate some AK production technology, which, here it should be not time varying. For today, it will not be time varying. Yeah, we have to. And they can trade the capital stock as before. They can trade the government bonds. You can think of the government bond also as money. There's no medium of exchange role of money here. And they'll not issue any equity or anything. That's the extensions we only do next time. So perhaps I should not even mention that thing here as well. And then there's a government. The government has some exogenous spending, and it taxes the output, and it issues some nominal bonds. Okay, think of nominal bonds the same as money. There's no medium of exchange role. Okay. And the friction is the incomplete market friction. So each agent has to bear his own idiosyncratic risk. He cannot sell off contingent claim on his contingent on this idiosyncratic risk. Okay. Later, again, they can issue some equity. There's some skin in the game constraint we did earlier. But again, today we don't do that. So I should strike out this as well. And we have no aggregate risk today. Okay, there's no fluctuation in idiosyncratic risk. We have not time varying. It's totally deterministic. Okay. Now here's the model more formally. So there's a model of capital and safe asset. So the safe asset will be the government bond. Each agent have the constant relative risk aversion utility function, the time reference rate rho, the discount with time reference rate rho, and that's the evolution of the net worth. There's a net worth change for an agent I tilde. That's this individual I in a particular sector. When he consumes more, the net worth is going down. He gets a return on the government bond. And then he puts a theta fraction of his wealth in the government bond, and 1 minus theta fraction he puts in the physical capital, gets this return. So he gets, for theta, he gets that, and 1 minus theta, he gets this. So differently, he gets on everything, the real return on the government bond, and then he gets excess return on this 1 minus theta. And then there's a no Ponzi constraint. So you can't run a Ponzi scheme, okay? We will go to this in more detail next time, why these guys cannot run a Ponzi scheme. Okay? The output is given by this. That's the output, and that's just A times K. As before, iota times K is the investment rate. If you invest at a higher rate, you develop more capital, and that's our idiosyncratic risk. We had this before as well. And then there's a tax. There's a tau is a tax, how much you tax output. So output is taxed here, and it's proportional to K as well. And that's where the government comes into play. The next slide will be all about the government, but we have a tax here as well. And there's no aggregate risk, so there's no DZ. We will do this next time. So far, we have no aggregate risk. We only have idiosyncratic risk. This is D tilde Z or Z. Okay, so they're incomplete markets, and you cannot issue these claims. These type of claims can't be issued. That's the first part of the model setup. The second part, so these are the balance sheets, how they look like for each citizen. They have the government bonds, or think of money. Then they have some capital, and then they have, that's the net worth. They don't borrow from each other. They all hold money or government bonds and some capital stock. Okay. Who is issuing the government bonds? That's the government. Okay. Now, what's the government doing? So in aggregate, the total capital stock is just integrating over all individual citizens in the country. But that's just the total capital stock in the economy. And as before, we have these AK economies. So everything is scalable with respect to capital stock K. So the government spending is G, the script G times K. So think of this like a little G. That's like the government spending per unit of K. Okay. The government tax is output, so it's tau times AK, so total tax revenue, real tax revenue is that. And the government is issuing bonds. The change in the government bond is drifting with a certain mu B. Okay, that's the growth rate of the bonds. And the government is also paying on the existing bonds, it pays an interest rate IT. These are nominal bonds. So if I look at the government budget constraint, it is just tau times A times K would be the real tax revenue. G times K is the real government expenditures, times P is the nominal, that's the price level. P is the price level. So that's the total primary surplus. In nominal primary surplus. Without the P, it's a real primary surplus, and without the K, it's a primary surplus per unit of K. Again, we have this AK technology. Everything is scaled up by K or scaled down by K, so that's essentially how it works. So if the government has a deficit, so if the tax revenue is below the government expenditures, it has to issue more bonds. So the government has to pay interest on the existing bonds, and it can issue more bonds than it has to pay interest. Then it frees up something and can actually have a deficit here. If the government has a surplus, but then it doesn't have to issue so many bonds. So actually it has to first pay off the interest on the bonds, but then this can be negative. So what's really matters in this economy, because it's a flex price economy, I should say, so far we don't introduce any sticky prices or sticky wages. It's a flex price economy. What really matters is mu check B. Okay, so that's mu check is the growth rate of the bonds minus the interest rate. That's a nominal interest rate. So everything is what's in script here is in nominal terms. Okay. So that's what we have here. So notice importantly, this I is not an interest rate clearing interest rate. It's not a market clearing interest rate. It's the interest rate the government promises or the central bank promises on paying on the bonds. That's the policy rate. Think of the policy rate. It's what's clearing the market will be the price of the bond. Okay, this is the price of the bond is in the script B. Okay. Later it will be this QB. I will introduce this notation in a minute. And the government can run a Ponzi scheme, so there is some no Ponzi constraint. So there's not a no Ponzi constraint. Okay. So that's the setting. So that's a setting. So let me see how this fits into the literature more broadly. And this that's where we are. I call it this I theory without I. There's an old paper of mine in the AR Papers and Proceedings 2016, which develops this model. So it fits in the literature. What people do money models often with OLG models. Okay, so in this type of overlapping generation models, and the classic one is Samuelson's 1953, I think, 54, where there's an OLG setting. And different generations cannot really save and borrow from each other across generations, always 2 or 3 generations only alive, and they can do this. So most models are 2-generation models, old and young. The Samuelson original model was 3 generations. And these are deterministic models. And what Peter Diamond did, Peter Diamond then introduced the capital into this setting. Okay. There's a parallel literature which is about incumbent markets and idiosyncratic risk. Okay. And in these models, you have some endowment risk, some exogenous endowment risk. So you have some labor risk. So labor income is shocked, and you have some, endowment risk, and you might have a borrowing constraint on top of it. And the first one who developed this literature, this money literature in the late 1970s, early 1980s, was Truman Bewley. And there's only money in it, like in the Samuelson setting, or only government bond. So when I talk about money or government bond, as long as we don't talk about a double coincidence of wants, it's the same thing. And then Ayagari put actually capital in it. Okay, so there's also in between, there's this Haggett model, but essentially it goes all back to Bewley. And what happens in this type of this literature, I think with market idiosyncratic risk, the idiosyncratic risk is actually the exposure you have is independent on your portfolio choice. Okay, so you can have a lot of capital, very little capital. It's the same. The idiosyncratic risk comes from your labor side. Okay. Now what we do is that the return risk is actually associated with idiosyncratic risk. So which means if you hold more physical capital, your also risk is going up. So risk scales up and down with your portfolio choice. If you tilt your portfolio too much more risky assets, you have more risk. If you tilt it more to risk-free assets or less risky assets, you have less idiosyncratic risk. Okay. So here what we do is the risk is tied up to the individual capital somebody has, and how much he tilts it to his own his portfolio choice depends on that. And this actually makes it easier to handle. And you will see in a minute, I will show this here. If somebody is wealthier and has twice as much as capital, he has also twice as much of idiosyncratic risk. Okay. So that's very different from this endowment risk. If somebody is 10 times as wealthy and has 10 times the amount of capital, it will be the case in Ayagari, for example, he has the same amount of idiosyncratic risk. So because this risk comes from his endowment stream and not from his portfolio. And here it comes from the portfolio. And we will work with this one. And this will turn out to be much easier to handle analytically. Okay. Okay. So let me just contrast this setting with the Bewley-Haggett-Ayagari, as I said before. So this is a stream, which is the Bewley-Ayagari-Haggett. So Haggett is in between. They just essentially use the Bewley model, uses the macro machinery to illustrate that. But Bewley comes out of economic theory as a general equilibrium theorist. So the Bewley-Ayagari-Haggett and how this contrast with our setting. So here I have written down the model which would encompass both. Okay, you have the Bewley-Ayagari setting and the model, the Bruder-Meyer-Sannikov type models. So that's the utility stream everybody gets, and that's a net worth, the evolution of net worth. The consumption reduces your net worth, and then you have a certain drift in income. And yeah, this actually I have to correct. So this should be dt. There should be this should be dy here. Okay, because it just translates into this thing here. And then there's the net worth. You get a certain the risk-free rate, and then you put in physical capital, and you get excess return from this, and that's your portfolio share, which goes into physical capital. Theta goes into the government bond, and 1 minus theta goes in the risky capital. Now, what we do essentially in our models now, the return for this individual I, what he gets on his capital, so there should be a K and as well as a superscript. He gets the expected return on capital, and then he has a risk exposure on that. Okay. So there is some idiosyncratic risk associated with that. And what we assume is that the income stream is actually in a strict form, it's actually zero. There's no additional income stream coming out, or it's a constant. So it's not the volatility here, that's zero. There is no endowment volatility. The volatility is just a constant stream, or it drifts without a Brownian exposure. While the contrast with Ayagari is, Ayagari switches off this thing here, so the return of capital is actually risk-free. So you don't have any risky return on the capital stock, but you have some some labor risk or endowment risk, which does not depend on your portfolio choice. Okay? So this should be dy, just where you can plug in this with a certain drift and with a certain volatility. I guess this v turned out to be, should go away too. That was a typo. Okay, so essentially what you do is in the model we will analyze is you have a negative shock, some of your capital is destroyed, and then you would like to have the government bond sell off the government bond in order to buy some new capital stock. Okay, and if you have your capital has a positive shock, you might say, okay, now I have too much capital, let's sell off some of this capital and get the government bond in return. Okay, so you build up or rebuild the capital stock after a negative shock. You also smooth consumption over time. And you want to hold essentially the government bond for precautionary reasons because you don't know whether some of your capital is destroyed or becomes more efficient in the next period. Okay. In a Harigari type model, you really want to smooth consumption. And it is the case that actually risk does not scale with your net worth. So the risk is fixed. So if you become much more wealthy and invest much more in physical capital, the risk is staying the same. So it doesn't scale up with your net worth. And this lack of scalability makes the analysis much more challenging. Okay, so it doesn't depend on your portfolio choice. So let me show you what the role in an income market setting is of this safe asset in a sense. So the income market frictions gives it a special role. And what we will see later on is that every asset, the value, that's the nominal value of all the government bonds divided by the price level. That's the real value of the government bond. Okay. That is the present value of some cash flows plus the expected present value of some service flows under a different SDF. Okay, that's a new stochastic discount factor. We will come to this stochastic discount factor. But to illustrate this, let's just have a simple example where there are two people, Alan and Beth, and they each have two assets. They have a safe asset which pays off no cash flows at all. So in this example, it has 0 cash flows. And then Beth has the same safe asset, also pays off no cash flows. But then they have different positive cash flow assets, which pays off some positive cash flows. And when the world goes up, Alan's cash flow expands and Beth's cash flows contracts. When the world goes down, it's exactly the opposite. Alan's cash flow asset contracts and Beth's cash flows expand. Okay. And then the world goes on further constructing. But the important thing is Alan and Beth, they have exactly the opposite movement in the positive or negative in the positive cash flow asset. So ideally, they should write contingent claims to each other. But that's where the income market frictions comes in. They cannot write contingent claims to each other. Okay. Now, what they can do is they can say, what we do is we actually have these assets. If the world goes up, Alan says, I buy some of your 0 cash flow assets, if it has positive value, in return to the positive cash flow asset. And when the world goes down, they trade in the opposite direction. Okay. So in a sense, from an ex-ante perspective, even though this asset has no cash flows, and you might think it might be a worthless cash flow, it's worthless. What should I do with a 0 cash flow asset? But it helps us through retrading to complete the market. Okay. So normally Alan and Beth could not trade, or could not write contingent claims on whether the world goes up or down. But because they can retrade in a different direction, depending whether the world goes up or down, they can actually partially complete the market, even though there was incomplete market friction. So the retrading is essentially partially completing the market, overcomes this market friction. Okay? And that's the service that this 0 cash flow asset provides. And we value that. Okay? So we value this. So there's a service flow to that. And because of that, it has positive value. Because if you just take the cash flow, the asset should be worthless. But it helps us to overcome the incomplete market friction. Okay, that's what economics, what's behind that. Notice the safe asset here is this 0 cash flow asset. So there's an asset, there are 2 assets. So there's this asset which has no cash flows at all. If you do standard asset pricing, we say 0 cash flow, Or the US dollar, it's the same thing. Yes. So the US dollar, it pays 0 cash flows. So in this framework, you can think of the safe asset as US dollar. So it doesn't pay any interest. The cash flow is essentially 0, as you said, or it is 0, not essentially, but it helps you to overcome this. You park some of your wealth in US dollars because if there's a shock, you can react to that and retrade and buy some physical. If some of your capital stock is destroyed, you use US dollars and buy some physical machines again. It does not, so we will see later on, it does not fully complete the market, but it partially completes the market. But it reduces the force of the incompleteness. And that's essentially what the beauty of this thing is. Of course, cash might have this, overcomes the double coincidence of wants problems on top of it. No, but this we have switched off for now. Okay, so think of US treasuries now, also in dollars. Okay, so this I would think of now government debt as a safe asset. Now, of course, there's a second equilibrium. If the safe asset, it has 0 value, because there's another equilibrium, but then Alan and Beth, Al will not say to Beth, oh, give me the 0 value asset, I give you my positive cash flow asset. There's another equilibrium where this asset has 0 wealth or value, okay? And then it has 0 value. And nobody wants to use it. And then we just have to bear this total risk, Alan and Beth. We have to live with an incomplete market friction. Now this here, the correlations is perfectly negative correlated. What we see, of course, in our model, we have a continuum of these guys, and all the shocks are idiosyncratic. Because here I only looked at 2, Alan and Beth, make perfectly negative correlation. Just to illustrate that, in the model itself, you have a continuum of guys, and all the shocks are idiosyncratically, all the Brownians. These tildes are all idiosyncratic to each other. But importantly, so the 2 important things, the pure existence of these pieces of paper, even though they don't pay any cash flows, has value because it helps us to overcome the incomplete market friction. And that will be very critical in this framework. Think of money, green pieces of paper. And if it has positive value, it helps us to overcome. But there's another equilibrium. If it has 0 value, then we don't accept this money. And then it's also worth 0 value. It's a second equilibrium, non-monetary, non-bubbly equilibrium. Okay? And this is almost like a bubble. You could think of this term here, cash flows discounted, they're all 0. The fundamental is 0, but the value is positive. The real value is positive. So it has a bubble nature. It's only the value comes only from the feature that I can retrade it. Now, if I cannot retrade it because it has huge trading frictions, it will not be a safe asset either. It has 0 value. The value comes from the ability to retrade it. Okay. Okay. So what we want to do is we want to build this now and put this together in this one sector model. So we use our step-by-step approach. Okay. Of course, it's a little bit simpler. So this might be, oh my God, all of these things now, but you remember all of it. No, you remember that you can now familiar. The only things we don't need is eta evolution because it doesn't, we have only one sector. So we don't have the wealth share, the net worth share of sector 1 relative to sector 2. We don't need that. But we have to, in particular, we have to work a little bit more on this idiosyncratic risk, the portfolio choice, and we have to work more on these value functions once we go beyond log utility. Okay, so here's our notation. So we have now 2 asset prices. So far, we only had the price of the capital stock, and sometimes we had also equity, outside equity, but now with the price of the capital stock, that's this guy here. And then now we also have the price of the government bond. So the script B was the nominal price of a government bond divided by the price level is the real value of the government bond. But I want to introduce a notation that it's per unit of K. So I have to divide it by the total capital stock. And I call this thing QB. Okay. So it's the same thing as QK. QK was the price of the capital, the physical capital, all the machines per unit of a capital, so per machine. And now I would like to know what's the value of all government bonds per machine. It's a little bit strange to make it per machine, but it's an AK model. I want to keep everything scaling there in respect to K. So that's why I introduced this QB. Okay. But QB times K is the value of all the government bonds. Okay. It's a bubbler. Or the numeraire is consumption good. So we will actually later introduce a different numeraire, but the numeraire for today will be traditionally one consumption good, one apple. This one? No, this is a value of the government bond, so it's an endogenous thing. So it's the price of the government bond. So the price of the value of all government bonds outstanding. Okay, so if there are 10 bonds outstanding, it's the value of all 10 bonds in. So this thing is in apples, and this cap B would be in dollars. Okay. The price of the consumption good, yes. So script P is the price of an apple. Yes. So then one element which will be very important is this var theta. That's the value of, so think of all the wealth in the economy. Some part of the wealth is this QK times K. That's the wealth of all the machines in the economy, of all the physical capital in the economy. Okay. And then there's the whole wealth, the real wealth, always in the consumption numeraire of all the government bonds. Okay. That's the denominator is the whole wealth in the economy, total wealth in the economy, the total net worth in the economy. So if there's credit, so credit nets out, no? But this can be bubbly here, this down here, and that's the total wealth in all the total economy. So if I take the total government bonds wealth, so the citizens hold the government bond divided by total wealth, that's what I call this var theta. So var theta is a fraction of the wealth, which is the government bond's nominal wealth. Okay. In real terms. Okay, so what is government bond wealth relative to total wealth in the economy? Yeah, no, but so var theta will be a very important variable, but it's not a wealth share. I mean, we will use it like it's not a wealth share across sectors. It's like a portfolio share in your portfolio. You know, so what fraction of your wealth? It's not individually, it's for the aggregate economy. What fraction of the aggregate wealth is money wealth, and what fraction is physical capital wealth? Okay. And so once I use this QB notation, that's why I use this as a QB, then it's just QB divided by QK plus QB. Okay. On this var theta, keep this in mind. This var theta will be with you now. It's your new friend. Okay. And so there's something. So why is this QB? Why is there no DZ term? There's no aggregate risk. Why is there no DZ tilde term? Exactly. They are wash out, and there's a continuum of them, so they're wash out. So they don't impact the aggregate capital stock. Some have negative shock, others positive, and on aggregate they have zero. Similarly, so there's just the capital stock just drifts with a certain drift rate, and the price of the QB, which is now the total wealth of all government bonds per unit of K, is also drifting. Okay, and hence the var theta is also drifting in a sense. Okay. Now, the SDF of each agent I, so there's only one sector, so it's I tilde in the same sector, they all live in the same sector, is like minus the risk-free rate is the drift, as we always had. There's a DT missing, sorry for that. And then we have the price of idiosyncratic risk. So what's the price of idiosyncratic risk? That was the volatility loading of the SDF on the DZ tilde. So there should be a tilde here too. Okay, there's a tilde missing on this Z term. And so there's a DT missing and a tilde missing here. And the price of idiosyncratic risk we call var sigma with a tilde. So it's the same notation as before. Everything which is idiosyncratic has a tilde now, okay? But otherwise it's the same notation. Then we have the same aggregate resource constraints output. That's essentially, I have total output is A times K. Remember, capital K was the total capital stock in the economy. A is the total output. Some of it I consume, some of it I reinvest to produce from the machines. I produce output. I have some apples, and from the apples I produce new machines. That's this term here. And some of it is the government is using, some of the output the government is using, okay, for some government expenditures, military, defense, whatever, okay. And then there's the capital stock. So there can, each of these guys can buy and sell some capital, and that's, you know, scaled by K, so I have to descale it, rescale it, and that has to be, they're experts or whatever within the sector that can buy and sell capital to each other. Okay? And then there's the valorizing goods, the bonds, and the capital markets. So here's a question. Why, poll question, why do risk-free rate, so here, this was by I, and I scratched it out, or why do the risk-free rate and the price of risk, I should say price of individual risks, do not depend on individual I's. Okay. Of course, if I have here the SDF, that's the individual SDF, why does it not depend on the individual I's? Shouldn't it depend? Because the risk-free bond can be traded, because aggregate risk can be traded. We don't have any aggregate risk, sorry. Hint. The constant relative risk utility for all agents is the same, gamma. A. So A explains this guy, no? Because you can, very good. And then this, you just essentially have all the same risk aversion coefficient. Okay. But it also means, because the bond, actually, I should say, it's also because they can also trade essentially also the capital stock. The capital is free tradable. So here should be risk-free bond and capital can be traded. No, that's correct, but then this might not be the same. This might have an I if the risk-free bond cannot be traded. Because, you know, if I am very patient, you're very impatient, but we can't trade it, then the shadow risk-free rate yours might be different from my shadow risk-free rate. Okay, now let's look at the government bond or / money. In this setting, government bond and money is the same. So the government bond is, or the number of bonds or coins, it follows the following. So I issue government bonds at a mu B plus I. Why is it mu B check plus I? That's a trick question. Yes. But the answer is that because this mu check is mu B minus I. No? So I have to put it back in. Oh, I could have written as mu B without the check and got written. That's just a new issuance of bonds. Yeah. Because mu check is the number of bonds I issue beyond what I have to issue to pay off the interest rate I promised. And then we have the Fisher equation. Remember the Fisher equation? The real return on the bond is the nominal interest rate on the bond minus the inflation, or I could have put the inflation on the other side. So this is written because the real return is stochastic. The nominal interest rate is fixed, so it's non-stochastic, but the inflation is stochastic. Now the change in the price level. Yeah. Now the change in the price level, I can just replace with this thing here. I just replaced, you know, this QB and use this QB notation and put it back in here. So I get this thing here. That's my Fisher equation. So essentially the real return on the bond is given by this expression. So how do I get from here to here? So one is that this I cancel out with this I, okay? And then I got rid of this B. So this B is growing. So this B shows this comes a mu B in there. Okay, and this comes in here. So this is minus mu B plus I, and this cancels out with this I. Okay, but this essentially is, we will use this thing here. The real return on the bond is the capital gains on the total value. This is the total value of all government bonds minus the issuance of the bonds. Okay, it's just a different way how to write the Fisher equation. Okay, so the real return on the bond, which means if I issue, what you see, if I issue a lot of new bonds, the real return of the bond goes down. Okay, that's like diluting. I issue a lot of new bonds, I dilute the existing bonds, the real return on the bond is low. You see? So that's like the dilution effect coming in here. Okay. Okay. So in a sense, if I issue more bonds, if I issue the bonds in order to pay interest on the bondholders, the bondholders are fine because I just pay interest to them. But if I issue bonds without paying the interest on the bondholders, I dilute their bond holdings, the real value of their bond holdings. Okay. Now, so I generate some seigniorage. Now, if you issue bonds and dilute it, then I generate the seigniorage. Who is getting the seigniorage? And how is the seigniorage paid out matters a big time. Okay. So the way we pay out the seigniorage depends by lowering the taxes. Okay. And then it depends what you pay taxes on. In our setting, you pay taxes on output. So if a rich guy has a more higher capital stock, he pays more taxes. And if I create more seigniorage, I can lower his taxes more. Okay. So we lower than the tax rate, and by lowering the tax rate, the rich guys benefit more than the poor guy. Okay. So we don't consider lump sum taxes, or we consider some. So let me just, there are different ways you can pay out seigniorage. You can actually pay out the seigniorage. If you generate seigniorage, you say, we pay a higher interest to the bondholders. I create some seigniorage and I pay a higher interest to the bondholders. But that's, I first dilute the bondholders and then I pay interest on the bondholders. So it's a wash. It doesn't do anything. There's no price stickiness in this model. So I dilute it, I print more bonds, create inflation, and then I pay higher interest. So with let's say a 1 percentage point higher inflation, I pay a 1 percentage point higher interest, nominal interest, so it washes out. Okay. Now I can also pay proportion to the capital holdings, proportion to the capital holdings. So that what happens is that I print more bonds, I dilute the bond holdings, and then I lower the tax on the capital holding, which is, the output tax is like guys who have a lot of capital that produce a lot of output. That has essentially makes the bond holding less attractive relative to the capital holding, because I create more seigniorage by diluting the bond value, and then the seigniorage I give back. So I keep government expenditures fixed. Now I can also throw it into the sea, then it's different. But I pay it back. So I pay it back to the capital holdings, proportional to the capital holdings. So the rich guy gets from the tax cut benefits more than the poor guy from the tax cut. So then it has a trade-off. So suddenly actually capital is more attractive to bond holding. Okay, that's what we will consider. So it really affects your portfolio choice. Okay. And now a third option would be I pay it proportionate to the net worth. 1 second. That would be the same. A fraction goes to the capital holders and a fraction goes to the money holders. So it would be a convex combination of 1 and 2. Okay. 1 has no impact. 2 has this impact on portfolio choice. So it would be the same, just a little bit more, not a little bit more muted compared to 2, but it would be the same as 2. Okay. Because 1 has no real impact. And then you can also pay it back the seigniorage per capita. Okay, and it's not the wealthy guys doesn't get, if you're 10 times as wealthy as me, you don't get 10 times as much of a seigniorage benefit. You get it per capita. Okay, so but if you have in this model, if you have no real effects from this, so if you're recording equivalence, people anticipate they will get this seniorage payout. And for them, it's part of the wealth already. So we get some seniorage benefit that's part of my wealth. So if there's no borrowing constraint, and so it has total Ricardian equivalence. So I can, for example, I print my bonds, create some seniorage, and I know in 10 periods I get it back from the government. It's part of my wealth already. Okay. But if you're in a model, and the most more macro models, what they have, and we will not have this, if you have a borrowing constraint like a Bewley, Haggard, Iagari type, if you put a borrowing constraint in, it could be that I pay you something now and I will tax you in 10 periods, and I don't generate any wealth for you, but I relax your borrowing constraint. So we don't have this in here, but that's just to keep in mind. That's typically how it works. Here we live in a world where there's more Ricardian equivalence. We actually work through this channel 2, okay? Or you can also think of the channel 3, which is just a convex combination of this 1 and 2. We can also later on put some borrowing constraint in, so we get this on top of it, but we don't need this non-Ricardian setting. That's correct. So mood check is a control variable of the government. The government will decide how many bonds to issue, new bonds to issue. So let me just correct it. Mu b is a the mu b is a control variable, and the I is a control variable. Both how many bonds you issue and how much interest you pay on the bonds. I mean, the policy rate is also a control variable. But what really matters is the difference. So that's why we say let's reduce everything to mu check. Okay. Do you see? So the difference matters. So that's making the policy choice variable is a mu b. Now the b itself is the value of the government bond. So if you issue a lot of bonds at a very fast pace all the time, and people anticipate you will constantly issue new bonds, you will create higher inflation, and that will dilute the value of the government bonds. Okay? So let's suppose the economy grows at 3%, and you issue bonds at 5%, you will have 2% inflation. You inflate the value of the government bond away. Okay. It's a tax, yes. That's correct. So the dilution is essentially an inflation tax. It's an implied inflation tax. That's correct. Okay. So still in step 0 in our step-by-step approach. Actually, we don't need this, so we have not reduced any aggregate risk. We should probably cancel this line. So what's the return on capital? So we always get the return. We get A times K. That's the output. Now I have to put the tax. Part is taxed away, no? Minus iota times K is what I reinvest. So that's for consumption. And that's divided by the price of QK times K. And now all the Q's have a superscript K because we have to distinguish between government price, bond price, and the capital stock price. So that's my dividend yield. And then I have the capital gains rate. That's the same as we had before all the time. This is all the same we had before as well. The only difference is we have now some taxes here. Okay. And then, so there's no aggregate risk. We will introduce this aggregate risk later. This should not be there. Then we have only this idiosyncratic risk on top of it. Okay. And why is there no sigma QK floating around? Because this QK is actually only has a drift. No, it doesn't have a volatility term. Okay. Now, this is just the government budget constraint we had before. I just divided by K. So the K is gone on both sides. And I also divided by the real price level. So that's now the real government budget constraint. Now, remember, we had this multiplied by K and then multiplied by the price level. So this would be QB times K, and this would be script B over the price level. Okay, so I got rid of the price level here. So that's the real thing. Let me just think for a sec. Okay. So then I can write, of course, I can replace the tax level here. I can replace it. The taxes are given. So if the seigniorage is higher, so if I print more bonds, I get higher seigniorage, the taxes go down. So I can replace this by plugging this in. So I replace this tau. So I solve this for tau and put this tau in here, and then I get this expression here. Okay. There's a mistake here. This should be the script G. So this should be this type of G here. Okay, this is not the growth rate of the economy. This is just this per K government expenditures, real government expenditures. And this comes, so you can think of if the government is printing, so what can you see here? If the government, so this scope, there's no aggregate risk, she should be gone here too. If the government prints more aggregate risk, if the government prints more nominal bonds, then it will be the case, it will generate more seigniorage. Because if it's more seigniorage, it can lower the taxes. So the real return on government on the real return on capital is going up. Okay. So that's what this term reflects. Okay. It's just a different way. You can just replacing the taxes. Now the taxes are, I just make the government change mu B. By changing mu B, it implicitly changes the taxes, or the primary surplus. So this is a primary surplus here. Okay. Just confused here because this was B over. Okay. Yes. Now we have to do the optimal choices for each citizen. So each citizen is now within the same sector. Each citizen is choosing my investment rate. That was the Tobin's Q. That's the same thing we had always. Now the only we have the superscript K because it's the price of capital. Then we have consumption net worth rate, and that's the mu check. I just define the consumption net worth rate as mu check. Why do I call it mu check? Oh, sorry, rho check. Because for log utility, it's rho, and I call it just this check. We have to solve it later. It will be more complicated with constant relative risk aversion. But that's why I call it, you can, if you don't like this rho check, just always write consumption net worth. Okay? So this is total aggregate, total consumption is then just rho check. That's my consumption net worth times the net worth. What's the total net worth in the economy? Total net worth in the economy is the total wealth of all the machines, so QK times K, plus the wealth which comes from the government bonds. Okay, that's QB times K. So that's the total wealth in the economy for all citizens. They all want to have a consumption net worth ratio. Remember, they have all the same time reference rate, rho. And that's what they want to consume, the total demand for apples. And so, as I said, looking, if you remember from the early lecture, partial equilibrium, consumption net worth ratio is given by this expression here. That was the time reference rate times omega. What was omega? This was the net worth multiplier or the investment opportunity moving around potentially. If you have log utility, then gamma is 1. So this is rho to the power of 1 times omega to the power of 0. So it's always 1. So with log utility, it's like this. Okay. And also in the steady state, omega is not moving around. Okay, so that's each guy has to make 3 choices: how much to invest, the investment rate, how much to consume, and his portfolio choice. Okay. So the portfolio choice, I don't solve yet. So he puts theta, fraction of his wealth, in the government bond, and 1 minus theta he puts in the physical capital. Okay. And the capital markets clearing condition is that 1 minus theta is QK that divided by QB plus, QK plus QB. So this should be a K. Okay. And the bond market clears by Waller's law. Okay. And this I defined earlier. I called this QB divided by QK plus QB, I called var theta, and that's just 1 minus var theta. So everybody chooses a portfolio. So that I put a fraction theta in the bonds and fraction 1 minus theta in the physical capital. And that has to be equal, that's a fraction of his wealth. This has to be equal to the total wealth in the economy in physical capital is QK times K divided by the total net worth in total wealth in the whole economy. Okay. And remember, this was our definition of this var theta. It's the same for everyone, yes. So it's a good point. So the portfolio, so the IOTA will be the same for everyone. The consumption net worth ratio choice will be the same for everyone, and the portfolio will also be the same for everyone. Remember, we're in a one sector world. They're all the same. There's just wealthier or less wealthy. They're just scale up versions of each other. So you're 10 times as wealthy as me. So your consumption will be 10 times as high, but your consumption net worth ratio will be the same. So you consume 10 times as much as we walk through. You always have 10 times as much as me. It's AK production function and constant relative risk aversion. Yes. So remember we had this feature in the constant relative risk aversion or power utility function where everything is scaled up. This is where we derived this omega. So the value function was U as a function of omega times net worth, the whole thing divided by rho. So everything scales up with net worth. So essentially, so this doesn't depend on constant relative risk aversion. This depends on this constant relative risk aversion, and this too. So we all essentially identical. That's a big difference to IAGARI, where we would be all different. Of course, in IAGARI, capital is risk-free. It's like the government bond, so it's perfect substitutes. But if you had idiosyncratic risk or had some risk in capital, then there would be all the poor people would do different than the rich people. Here, I'm a poor chap, you're the wealthy guy. But you just, in terms, you invest 10 times as much in the physical capital, but in terms of portfolio share, you choose the same theta in bonds and 1 minus theta in capital. Okay, so once you put this all together, that's what you get. So I was cheating a little bit. Why was I cheating? So that's the value of the government bonds per unit of K, real value of government bonds per unit of K. That's the price of a machine, and that's the price, that's the investment rate. And this A check is now, is the productivity minus the government, G times K, okay? And for log utility, this rho check would be just rho. And there's one equilibrium, so if this is zero, if money is worth less, then var theta is zero, so this would be zero, this would be zero, so QK would be, this term would go away, this would be zero, and I think there's a typo here. This is not T. I have to look it up what this is. Okay, so I have to. Sorry, there's a typo here. This is different. I think it's 1. To look it up. So that's what it is. But how was I cheating? I didn't solve the portfolio. Just said, oh, if the portfolio is 1 minus theta, and then this is a capital market clearing, but I haven't solved it. But the beauty of this thing is, whatever your model set up, if you're 2, 3, or 10 sectors, this always holds. Okay. But now we have to solve the portfolio, and then we push the portfolio, and then we solve the whole thing. So because, or put it differently, this var theta is not solved yet. So we have to solve the var theta, and then we have solved the whole model. Okay, but this holds very generically, so it's a very powerful thing. Can you check what this t should be in the PDF? Oh, it should not be there. Okay, because I know these formulas typically. Okay, now, so now I would like to, we have to do the portfolio choice. Now, so far we cheated, we didn't solve it. Now I have to solve it. Okay, and for doing this, then I get the manipulation equation or the FTPL equation. Okay. Now, portfolio choice. What do we do? Martingale method or stochastic maximum principle or HJB approach. You pick, but we use Martingale because it's the simplest in this setting. So the Martingale method, recall the Martingale method, if you have two risky assets, one risky asset A and one risky asset B, the expected return of asset A relative in excess to asset B is the price of risk. And this could be a tilde or could be not a tilde. So this is just, perhaps I should write here var sigma, then there's the price of risk. Perhaps I should put all tildes on top of this. Of course, it holds for aggregate risk. It also holds for idiosyncratic risk. Now I can price, I can do this. I have four alternatives to make this derivation of this Martingale method. So the theta is in this var sigma. No? There are four ways I can do it. And the most obvious way to do it, and that's what we will do now, is I take the consumption numeraire, so apples, and I expected excess return of capital with respect to the bond return. So A is the capital stock and B is the bond, B for bond. I could also price the expected excess return of net worth with respect to the bond. It's a little bit of mind-blowing. I don't have to price the capital relative to the bond. That's the most natural, what we always do. I could actually price the net worth, which consists of the bond and the capital relative to bond. I can just use that. No? And I can also do the whole thing instead of the consumption numeraire. I can do it in a net worth numeraire. This fourth method, which is a little bit mind-blowing, is essentially the most elegant way to do it in the model with aggregate risk. Okay, so once you have aggregate risk, you want to go away from the consumption numeraire to the net worth numeraire. And it also turns out to be much simpler to price everything of the net worth relative to the government bond. Okay, so you don't price capital relative to the government bond, you price your net worth, which consists of the government bond and the capital relative to the government bond. Okay, you save a lot of algebra by doing that. But today we do it the pedestrian way because we have no aggregate risk. It's easy to handle with consumption numeraire, and it gives you the standard intuition. Okay, so we have now, we price capital relative to money in the consumption numeraire. Okay, so what's the expected return of capital? We have things. Why is there a check? Because it's after taxes, no? It's minus the government. So it's A minus the government thing. It's not because you don't get your taxed, actually. Now, and this, so that's the investment. So that's the dividend yield after taking this into account. Then we have the capital gains rate, the expected capital gains rate. Then there's drift of QK. So that's the capital gain. So Q times K, that's a drift of K, that's a drift of Q. The new term is this guy here. What is this time here? That's a seigniorage term. Now, if the government prints at a faster pace, it creates some seigniorage and lowers the taxes for the capital on the capital. So this improves the capital return. Okay. So that's the expected capital return. The required capital return is the risk-free rate plus the price of idiosyncratic risk, this with tilde, times idiosyncratic risk. Okay. So we always had this. We just have now this for idiosyncratic risk, so we have little tildes on top of it. Okay. Now, what's the expected return on the bond? So the expected return on the bond is just the real risk-free rate. That's what we require. But how do you think about that? So if the economy grows at 3% and I print bonds I just don't print bonds at all. I just keep bonds fixed in supply. What's my inflation rate? So the economy grows at 3%. The bonds don't grow because I keep it fixed. Negative 3% because I have deflation. If I say now I print bonds at a 3% rate, then it will be the case that the inflation will be zero. Okay, and if I print bonds at a 6% rate and I have 3% growth, I have 3% inflation. Okay, so this is essentially from the bond printing diluting the bonds. Okay, and then there's the growth rate of the economy. But if I print the bonds the same pace as the economy grows, that's fine. So otherwise I create deflation. And then there's also the growth rate of the value of the bond, which is an endogenous thing. Okay. Now I want the difference between the two expected returns. So this is the difference. So how do the bonds and the capital differ? Capital gives me some dividend yield, bonds don't. Okay. Bonds will be devalued from bond printing, diluted, gives me seigniorage, gives me capital. So this gives me this difference here. This is the same. That's the growth rate of the economy. That's the growth rate of the capital stock. That's the growth rate of the economy. It's the same for both. And then there's a change. There's a deterministic drift in the value of the price of the capital and the value of the price of the bonds. And that's all, that's endogenous. I have to solve for this later. And then there's the risk rate is the same. The capital stock, I want a risk premium for it. For the bonds, I don't need a risk premium. Okay, they're not risky. So then if I take the difference, I get this expression. Now, so that's my thing. So remember the portfolio choice in this var sigma tilde. Now, there's some little bit of algebra to get this guy here. This becomes this guy here. To see this, I've put some hint here. Okay. So this is for you to at home to figure out what is the drift of this. And we don't need this, just the drifts here. And then you can see already, I can rewrite it, becomes this element here. I want to express everything in var theta terms. Okay. So all of these things I want to get rid of. I don't want to deal with the capital price and the bond price. I want to just deal with the relative of this var theta. Okay. And this, this I get automatically here. That's a seigniorage distribution. So that's my thing. And now I still want to say a little bit about this var sigma tilde. What is the var sigma tilde? Everybody? Price of idiosyncratic risk. Okay. So how do we get that? Recall the price of idiosyncratic risk was when I look the SDF, it's a loading on the idiosyncratic Brownian. No? The SDF, the drift was minus risk-free rate. Then there was the loading on the aggregate risk. We don't have that. This is var sigma minus var sigma. And then I have the idiosyncratic risk. So it's this guy here. Now, what is then from the envelope condition? So the SDF is just the discounted marginal utility. The marginal utility, if you have constant relative risk aversion, is just c to the power 1 minus gamma over 1 minus gamma. Take the first derivative. I get this guy here, discounted. Now, the consumption net worth ratio is rho hat or rho check. Sorry, rho check. So I can replace it with this guy here. If it's log utility, this rho is just rho check is just rho. Okay. So once I plug, so if I want to know what is this is a the var sigma tilde is just gamma, the volatility of the net worth. So how do I get to this guy here? So that's the volatility of sigma etos lemma. Whenever I ask something, you should say etos lemma. The volatility of this xi is the volatility of this n, no? And then there's this gamma here floating around. And perhaps I forgot the minus. Should there be a minus here? I think I forgot the minus. No, there's no minus, but now my math, somewhere, oh, because there are two minuses. So there's a minus gamma, and then there's this other minus, and then it becomes a plus. Do you see? Okay. So that's it. And what's the idiosyncratic volatility of the net worth is just 1 minus theta times the idiosyncratic risk of the capital. Because 1 minus theta I put in the physical capital, and theta put in the government bond. And this theta and this var theta is the same. Okay, the var theta is an aggregate, and the theta is individually one, but it's the same in this model. So that's what it is. That's my, typically when we are this is in step 3, what we do. Jump to step 3. With log utility, gamma is 1, and then it's just this. It is a row check is just rho. Okay. Now I can plug in now this. I just replace this this var sigma. I can replace it. I get this price this from the other slide. Capital markets clearing. I have theta is like var theta, and if I put all of this together, and you do this at home, no, but it's just simple algebra. It's the so-called money valuation equation, or it turns out to be the FTPL equation. The drift in var theta, which is the drift in the value of the government bond relative to total wealth, is rho check plus the drift in the money printing minus gamma 1 minus var theta squared sigma tilde squared. Okay. And in the steady state, it is of course this drift is 0, and then I can solve this this way. So the fraction of wealth, which is in physical wealth, now 1 minus var theta is in physical wealth, is a function of this rho hat. In log is would be rho. So plus the bond printing. So if I print more bonds, I put more into physical wealth. You see? If people are more risk averse, I put less into physical wealth. Makes sense. If there's more idiosyncratic risk, I put less in physical wealth. I put more in bond wealth. You see, it makes all sense, no? And isn't it, man, you must say it's beautiful, isn't it? Now, this was the open thing. The 1 minus var theta was the thing in the formulas I didn't have. But now I have it in the steady state. And I plug it in. Of course, there's another steady state. If this var theta is 0, that's also an outcome, okay? I plug it in. If the var theta is 0, I have this non-monetary equilibrium. Otherwise, I have this whole thing. Oh, there the gamma's missing. Or we have to fix that. So there's always, whenever there's a sigma tilde, there should be a square root of gamma here, and here, and here, and also here. Wherever there's a sigma tilde, there should be a square root of gamma. But in any case, no, sorry. No, forget. We're in the log utility case, so gamma is 1. So for log, I know that rho is equal to rho jack, and gamma is 1, and I have an explicit solution for all of that. And this is like an Aigari type model with closed form. Nobody says, wow. It's beautifully solved, everything. So that's essentially what the outcome is. And actually now we can check where this minus this t comes in here. Yeah, there's no, so actually this is just getting rid of this t's, no? Okay, so now I want to do some comparative static. So I'm much slower than I thought. Can we do another 20 minutes? It's really important. And it's really exciting too. Oh, you have seen it before. So if I take the sigma tilde, okay. So if sigma tilde goes up, so you see, so if sigma tilde goes up here, QK is actually going down. Okay. So it is the case that as there's more idiosyncratic risk, the price of a machine goes down. But if sigma tilde goes up, it is also the case that actually QB is going up. Yeah, so you have to believe me that so you can show that. You can see if you take these two things together, you can show that if sigma tilde goes up, the QB is going up. So this effect dominates this effect. Yeah. And here's this picture. So if sigma tilde is going, if purely competitive static, the price of capital is going down and the price of government bonds goes up. That's like a flight to safety. We will see this more generally, but it's purely competitive static. If I have two economies, one with a high sigma tilde, the price of the government bond will be much higher, the value of the government bond will be higher, and the physical capital will be lower. And if an economy with a low sigma tilde, less idiosyncratic risk, the government bond will be worth less, but the high price of capital will be higher. And if I were later, we will have this sigma tilde move stochastically around with aggregate risk in a setting with aggregate risk, then it will actually, whenever we go in a recession and the sigma tilde goes up, then actually the government bond will appreciate in value. Okay. And do you have an intuition why that's the case? Whenever sigma tilde is high, you want the market incompleteness is actually very binding. No, sigma tilde is the amount to the incompleteness of the market is very binding, and your service flow is extremely valuable. Okay. So you really want to do this retrading to overcome these incomplete market frictions, and the government bond is giving you this. It doesn't give you any dividend cash flows necessarily, but it gives you this retrading, the service flow, and it's really valuable in bad times when the sigma tilde is high. And that's why you put such a high value to government bond in sigma tilde, okay, when sigma tilde is high. Now the other thing is I can also do comparative static with respect to mu b. So what happens, do you think, when I print bond at a faster pace? Then you say I dilute the bonds more, so the value of the bonds is going down. You see that as mu b goes up, there's also a minus sign here. This QB, or the total value of the government bonds, is going down. Okay. And actually, what happens to QK is going up. Okay. So what we can do comparative static with this mu check B. If this is 0, what does mu check equal 0? It means I just print enough bonds to pay off my interest promised. Okay, but then the primary surplus of the government is 0. Okay. Now, in this case, the primary surplus is 0, but it is still a valuable government bond. This was the example with Allen and Best we had initially. The primary surplus is 0. If you hold all the government bonds, you get never any cash flow. The primary surplus is always 0. But you like this bond because it helps you to retrade and to insure. Allen Beth like it because they can insure themselves. So it has positive value. Even though it's 0 cash flow, it's positive value. So it's bond trades at the bubble. But you can do actually, as a government, you can say, wow, this bond bubble is actually nice. I can print even more and issue new bonds and what we call mine the bubble. You can milk the bubble. Okay, so you can print bonds. By printing bonds, you can have a negative primary surplus. Okay, so you print bonds, you have a negative primary surplus, and as long as you don't overdo it, you can do it. Okay, so you can run a negative primary surplus all the time. So it's like a steady state. I always run 1% deficit every year forever. It's like a Ponzi scheme. Okay, the government can run a Ponzi scheme. Okay. Of course, if you look at this, it will be the case that the R will be smaller than G in this case, because as you print more bonds, you depress the R. Okay, it's an endogenous thing. Now, the traditional way is to say, traditional financial FTPL, fiscal theory of the price level thing, I run a primary surplus, and then R will be larger than G, and then actually the real value of the government bonds is just the discounted primary surpluses. Okay. So there's no bubble. There's still a service flow. You can still use if there's a bond. Essentially, government is issuing raises taxes and uses the tax revenue to buy back the bonds. So mu b is negative, so it buys back the bonds and destroys them. Buys back the bonds and destroys it. So the real return on the government bond is high. It will be higher than the growth rate of the economy, and so you get the traditional FTPL equation. The real value of the government bonds is the discounted primary surpluses. This is S little s was primary surplus per unit of K times K is the primary surplus. That's just what the standard FTPL equation is. Okay. So, okay, this is one particular equilibrium. There's also another equilibrium where QB is equal to 0. Without a bubble, then the households have to hold all these idiosyncratic risk. There's no free trading, there's nothing. They just have to bear it. The bond pays into risk, but risk-free, but it could be a negative thing. If the bond print a lot of, so in real terms, in nominal terms, to pay positive, nominal. But it could be the nominal interest rate is 2% and inflation is 3%, so to pay a negative 1% real interest rate. Okay, so essentially, what's a Ponzi scheme? What's a bubble? What's the difference between a Ponzi scheme and a bubble? A Ponzi scheme is you always issue short-term debt, and then you issue new short-term debt, pay the old one back, and you issue another one-period debt, and you run this Ponzi scheme. Here in this setting, it doesn't matter whether you want to see it as a Ponzi scheme or you issue a bubble. It's like a long-term asset. The bubble lives on this long-term asset, and you don't have to pay it back because it's a long-term asset. Let's say it's a perpetual bond, but you can issue a new bond every period. So to expand the total supply of bonds, okay? So you can have a Ponzi scheme where it's always a one period or one instant bond, and you pay back the old bond and issue more. First, you issue some new bonds to pay back the old bonds, and then issue a little bit more in order to get some to milk the bubble, okay? Or you can say, I have a long-term bond initially issued, and then I don't have to pay anything back, and I issue another long-term bond on top of it, always with perpetual maturity. And as I said, reserves are essentially perpetual bonds. And so that's what the reserves are. So we be more in this bubble scheme, but it doesn't really matter. This is just different interpretations. We don't have any rollover risk here, okay? Because these are all nominal obligations that can always satisfy them. Now let's do the whole thing with constant relative risk aversion utility. Now we have all these gammas floating around, but the whole formula is the same. The only thing is that more difficulty is the time preference rate is rho, but it always shows up. There are a lot of mu checks showing up. Oh, so this rho should be rho checks. Several of them should be rho checks. There are some typos here. So there should be rho checks. And we have to solve for this rho check. Okay, that's a consumption net worth ratio. Likewise, with log utility is just simply rho. Now there are rho checks. Okay. Now comes another important trick. So remember when we did the step 3, we said, oh, every agent has this value function, and we have to deal with these value functions, and we want to get the capital stock, capital K out of it. We descale it by the capital K. Now within a sector, we have different people with different wealth, and they have different net worth. And we would like to descale them by the individual net worth share, okay? So I want to have some little v, which does not depend on the aggregate state eta, or which only depends on the aggregate state eta, which we don't have in this setting. But I don't want it to make it dependent on individuals' wealth. I know that you have 10 times as much wealth than I have. I don't want to make it dependent on it. I want to make it the same v. We all have the same v, and then I just have to multiply by something. So what I do is, remember, this was our value function. I took out this structure. This was the net worth multiplier. So I take this. This is my little v. I want to have this little v. And I took out this guy. This was individual net worth divided by total net worth. I could have put a superscript I here as well because we only have one sector here. Okay. So essentially, there should be a superscript I here, but it's capital N as well. So that's a network share of the agent I tilde within the sector. Okay, remember eta was the network share of sector 1 relative to sector 2, and eta tilde now is the network share within the sector. Okay, and this what we took out last time. Now I took out this guy as well, and then I have a little v, which is this, I can treat the same across all agents within the sector. Okay. Okay. And then I have to say, what's the evolution of this net worth of this eta tilde, so the net worth share within the sector. I should probably put some I's here everywhere, but it doesn't matter because we have only one sector. And then I just apply Ito's quotations rule, okay, to get the whole thing. And by Ito's lemma, I get then this expression. Okay, I will jump a little bit given the time constraint. So that's essentially if I want this thing here. So remember, this is the guy. This is given by the Ito's lemma is given by this expression. But what I'm really after is I want the evolution of this little v. This little v is the same across all the agents in this sector. And then, of course, I have to correct for this. Okay. So if the capital V is a little v, I descale it by this well share within the sector, and I descale it by the total capital of this. Now, by Ito product rule, if I use on this Ito product, if I want this thing, the drift of this is the drift of this times I have this guy here. That's from the previous slide. So I have this drift here. That's this drift here. And then I also have the K. And then I have this, that's the product rule. And I have this 1 minus gamma. So there's 1 minus gamma here. And that's this from the product rule, how these two guys could move with each other. Okay. So I have to, and the K grows at this rate. So that's my total drift. And I have this 2 Ito term floating around. And then I have some volatility terms. I'm mostly interested in this Ito product form. And then we said, okay, this is just purely applying Ito from this. And then I use that the net worth has to follow a martingale corrected for my consumption. Remember, this is what we had. This is what we had before. This follows a martingale we had in the previous lecture. That still holds. Okay. So the drift above, so this drift above has to follow this thing. The rho plus the correction. What was this correction again? Remember, when you do a self-financing trading strategy, you get the dividends, you reinvest the dividends. Here, if it's a total net worth, you get the consume out of it. You put the consume back in. Oh, that's what this thing is. And so on this thing has, so after this thing here has to be equal to this thing here. So that's what I show here. And of course, I took this. Why did I take this out? Because we have no aggregate risk. So sigma is not showing up. So you get this expression. And then that's my backward stochastic differential equation. This is the guy here. And then in steady state, I'm interested in the steady state. This little v is not drifting. So I would like to know what the steady state is. And then I solve everything for this rho hat. Sorry, that's my, the consumption net worth ratio is rho hat. And then I get for my rho hat, I get this expression. Okay. How do I solve this? This is just from the last, or numerically, there's an M missing here. That's just rho hat is just rho minus 1 minus gamma. So if you're in log utility, you can see already this whole thing goes away. So I plug in for this iota. I have the explicit expression here. And I have this 1 minus var theta. I have the explicit expression here as well. I plug it in, and I have to solve this in the computer. Okay. I have to do a little bit longer today because this is really important stuff. Sorry for that. I wanted to show you 2 ways how you can do asset pricing in this framework. The traditional way and a new way. And I alluded to this already. The traditional way, if I say, how would you value all government bonds? This is QB times K. You just take all cash flows from the bonds, which are all the primary surpluses the government pays. So if you have all the government bonds, whenever the government makes a surplus, it gives something to the bondholders. Whenever it makes a deficit, it says to the bondholders, give me some more. So if you have all the government bonds in the world from this government, you get the primary surplus as cash flows, and you just discount it with the SDF. Okay, that's your essentially that's what you do, and then you have potentially a bubble term here. So this should be some script T here, like no, sorry, this should be the same guy here, just with a capital T. Okay. Now that's how we typically do it. So the problem is only if R is smaller than G, there's this bubble term, and let's suppose you have a government debt which grows at a rate of with GDP, and GDP grows at 3%, and the risk rate is 1%. Then you have a deficit. And so the cash flow is negative and grows, a negative grows with 3% with GDP. And I discounted, bring everything back by 1%. So this becomes minus infinity because negative, there's a primary deficit each period, it grows with 3%. I discount with 1%, it's minus infinity. So the bubble term has to be plus infinity because I get a finite number here. Okay. So it's not really meaningful to do that. The better way to do this is not to price a buy and hold strategy. I hold all government bonds and just get the primary surpluses. I really price the cash flows I get from the retrading strategy. So if you price your bond, so you're a guy, you're Mr. I, perhaps I should make this Mr. I tilde, so there should be all I tildes here. I hold a bond. Whenever you make a positive shock, you buy more bonds. So you have a negative cash flow from buying your bonds. Whenever a negative shock, you sell some of the bonds, you get a positive cash flow. And you say, what is the stream of this, this buying and selling? How do I price this cash flow stream I get from this buying and selling on top of the cash flows? Okay. And I price this. So that's essentially what I do. So you have a share eta I of these bonds, and you get a share eta I of the cash flows, but you also have some trading cash flows, okay? Because you constantly buy and sell these bonds, okay? So you get the primary surpluses, might be negative all the time, but when you have a negative shock, you sell, you get a positive cash flow. If you're a positive shock, you buy, you have negative cash flow. And then what I do is, this is for you alone. Now I integrate over all the guys. So if I integrate this, so just look at this line, integrate over all the then I get, so this was the bond holding, the value of all the bonds you hold, I integrate over all, then it's just the real value of the government bonds. And then you get this expression here. No? And now I do a trick. This is an integral over di, and inside of the integral, there's an integral over dt. Okay. And you know, inside this is each individual guy's, I think the transversality condition is holding. So it's each individual guy's optimization. The transversality condition is holding inside this expectations operator, okay, or including the expectations operator. And then I integrate, okay. But I can do the opposite. I can also say, I first integrate over the types first integrate over time, and then I integrate over the type. So I flip the two integrals. Okay. So then I get this. So the di comes in here, and I have asset cash flows, and I have again this di here, and then this dt term subsequently. So the two integrals are flipped. Okay. So this means essentially now what I have is I have the price of all the government bonds is just the expected discounted value of the cash flows based on a new SDF. Okay, that's a new SDF, a new stochastic discount factor, Xi double star, plus an expected value of some trading cash flows from this buying and selling. Okay, and that's my service flow. Okay, and what is this new SDF, this Xi double star? This new SDF is essentially the SDF of the repressive agent. So if I were to price an aggregate consumption stream as a whole and say, what is the total wealth in the economy, which is the physical capital wealth plus the bubbly government bond wealth. If I price everything and I say this whole thing has to be supported by the aggregate consumption stream. So if I discount this with the new SDF, then I get essentially my total net worth, the economy. So it's the repressive agent SDF, the repressive agent in this incomplete market setting. Now, and essentially, when you look at it, what is it? Why is it? What's the this is a marginal utility of an individual agent I, and that's the net worth of the agent I. This is negatively correlated. So when the net worth goes up, you have a positive shock, your marginal utility goes down. When you have a negative shock, your marginal utility goes up. So this is negatively correlated. That depresses the interest rate you discount with. Okay. So this quasi SDF or this repressive agent SDF, this Xi double star, that's the one I used in order to split the asset pricing equation in this discounted cash flows plus the discounted service flows. And now the transversal condition holds, so I never have these infinity terms to float around. So it's a much better interpretation of the outcome. Now, I can use my money valuation equation. That's what my money valuation equation. All what I do here is just multiply this var theta, so I get the arithmetic drift. And that was my money valuation equation. I noticed that this guy here is my risk-free rate. Okay? Remember, for log utility, rho times the growth rate, that's this guy here, minus the precautionary savings term is my risk-free rate. We had this many times. And then I integrate this forward. And as I integrate this forward, and I won't have the time to really go through it in detail, I get, at the end, I get my FTPL equation. This is just the bond, the real value of all government bonds, discounting all the primary surpluses at the risk-free rate. There's no aggregate risk, so I just discounted the risk-free rate. And so you can see that once I integrate this forward, just integrating it forward, I get this expression, and I replace this this mu check with my government budget constraint. So this mu check, if I print more bonds, then I can afford a negative primary surplus. Okay, that's what I just replaces mu check with S over QB. So I can do it this way, or I can do it in a different way. I can do the same thing, the same equation as before, and instead of there's something, so there's one term missing. So this is plus G I put in and minus G. There should be a minus G here. So I add a G and subtract. That's the growth rate of the economy, which is the growth rate of the capital stock. And if you play this through, because K is growing at the rate of G, or this thing is growing at the rate of G. So that's why I can use this. I just add the growth rate of the economy and subtract the growth rate of the economy, and then use this as the risk-free rate. Then I get this expression. Then I get essentially traditional FTPL equation. If I don't add the G and subtract the G, I just use this money valuation equation directly and integrate it forward. Then I exactly get the term I always wanted, the value of the government bonds is the discount. This is my discount factor, C double star. This was the whole primary surplus is discounted by this C double star. And this term here is my service flow. If there's more idiosyncratic risk, I have more service flow. If there's more handling of the capital, then I have more idiosyncratic risk exposure, so there's more service flow. And you can see that if this B is 0, this will also be 0. So it relies on a positive real value of the government bond. Okay. So this thing, I was jumping over that. This is just my, the C double star has this, is this element here. So this we had in the previous slide where we derived this for log utility. It becomes this term here. Okay, so let me just say this again. So the value of the government bonds is just the value of primary surpluses discounted at this C double star plus the value of the service flow discounted at this C double star. Okay. In this deterministic world, this C double star is just a number. It's just the risk-free rate. Okay. And what risk-free rate is it? it is essentially rho plus the gamma times the consumption growth rate. There's no aggregate risk in our setting. There's only idiosyncratic risk. So it's essentially instead, typically when we have risk-free rate, I have total risk, aggregate risk, and idiosyncratic risk. Here, I just take this guy out. Okay, it takes this guy out. And in log utility, this gamma is just 1. Okay, so again, this is the service flow term. Now, finally, I want to do in 2 minutes, one final important thought. In this economy, each of us has idiosyncratic risk. So if we all start out equally wealthy, over time, we will become, wealth inequality will become worse and worse. Okay, some of us have a positive sequence of positive shocks, others have negative shocks, but we become, inequality will become bigger and bigger over time. Do you see that? Because they're all permanent shocks. Nothing is temporary. They're all permanent shocks. So if you start out, everybody has one initially, $1, let's say, and then after one period, the distribution looks like this. After 5 periods, it's like the yellow one. After 20 periods, it looks like this. So the distribution becomes log normal. It's more and more spread out, okay? Because we all face idiosyncratic shocks, and there will be some guys, very unlucky guys, who have millions of negative shocks in the sequence, and very lucky guys of millions of positive shocks. And there are many people in between. So the longer we play this game, the more extreme the distribution becomes. Do you like that? No? Why not? Because you will be one of the unwealthy guys? Yes. So what you can do, you can actually say, let's generalize the model with a certain Poisson arrival rate, individual Poisson arrival, individual shock. People have idiosyncratic Poisson shocks where the wealth is moved back to the steady state wealth. Okay. So we start with wealth of everybody has 1, and then some are lucky, and then if it drifts, and it comes with a Calvo theory, but it's not the Calvo theory. It's just okay. Now your wealth is back to the initial. It's back to. It goes with the aggregate economy, but it goes back to the steady state. Okay, or the balanced growth path wealth, and everybody is hit by that. So there are some shocks, and these are some jumps. So your wealth jumps back. So with a Poisson intensity lambda, the net worth jumps back to your steady state net worth share. So with log utility, there's actually the same return, no impact on equilibrium. So if we can calculate, the whole model is the same. It's just the only difference is that our wealth distribution is different now, but all the economic analysis would be the same. Okay. And so what you have here, so you have, the change in net worth is minus the consumption net worth. That's rho with log utility. The growth rate of the economy, that's for that's phi of iota minus delta. Then we have the expected the dividend yield. That's the capital, the portfolio share, which is in capital. Then the shocks, and then you have this jump here. Okay, and the net worth grows in total because there's no aggregate shock. It just grows at the rate of G, which is this guy here. And then the wealth share, we can do this eta. Eta is just the wealth share, eta product rule. And we can do it in such a way that, whenever occasionally you jump back. And if you do that, you can characterize the Kolmogorov forward equation. Now we can use the Kolmogorov forward equation and say, how does the wealth share evolve over time? And so here is just an application of the Kolmogorov forward equation. So we have this Kolmogorov forward equation. Why is there 0? We want the stationary distribution. It's a simple case. We don't want the time evolution, which is a stationary setting. And in this one, you can solve this. So if this is the Kolmogorov forward equation, that's the one we have. With a lambda, you jump back to the old one. So this one you can solve in closed form. So this is, Euler did this. No, Euler did this. He was a mathematician who did most of the things. He has an immense amount of theorems proven, and so you can solve it in closed form. So this the stationary distribution is a closed form with these constants, and the constants are given by this. C1 and C4 is the constant is this, and C2 and C3 is 0. So T2, this goes out, this goes out. These are the two constants here. And then you have actually an explicit solution for the G in closed form. And that's how it looks. So you have, that's the distribution if you run this model. So if you don't like that the model, the distribution, the cross-sectional distribution of people become, the wealth distribution becomes worse and worse, you introduce this element and throw them back in. People might die or not born independently how wealthy the parents were and things like that. And they start with the steady state, the wealth share again. And so you get this distribution here. So that's, you can do this. It's just an example where you can play around with the Kolmogorov equation and get an explicit analytical solution. You don't even have to do it numerically. Now, this is done for log utility. Your homework is to think about how would it work for constant relative risk aversion. Okay, how would it be more complicated? And I gave you some hints here, but you can play around with that. Okay. So let me conclude, and sorry for taking so long. I didn't anticipate that. I was actually worried that I will be done too early. So I provided first some intuition about different monetary theories, and we will do this after next time in much more detail. But today we really did a store value monetary model with one sector only and constant idiosyncratic risk. We talked about safe asset. We're talking about important service flow in a model with incomplete markets. And the government can actually issue a bubbly asset and issue even a little bit more and mine and dilute the value of the bubble. And people are still willing to hold it because it gives you this value, this service flow that you can overcome these incomplete market frictions. And importantly, at the end, I gave you two ways how to price assets. One was just buy and hold, like what we do all the time, just discount future cash flows when primary surpluses in case of the government bond, or better, discount actually the cash flows you get from this equilibrium positions, the equilibrium trading. You get when you sell it, you get cash inflow. When you buy it, you get cash outflow. And next time what we will do, we will actually do time varying idiosyncratic risk. And now we have aggregate risk on top of it. And once we have this sigma tilde moving around in a stochastic way with aggregate risk, then it will be the case that whenever we go in a recession, the value of the government bond will go up endogenously and we'll get a negative cap M beta. And that makes the government bond really valuable, okay, because it gets a negative beta and makes quantitatively a big difference. So let me leave it at that. And, I'm looking forward to Wednesday, 8:30 in the morning.